So we are live. We have around 25 participants.
Fantastic. Shankit, you'll kick off, right?
Yes.
Fantastic.
Okay. We've got a few more people coming in, but I'm just going to say, good evening to everyone, and welcome to our talk, Investing in India by Understanding India with Saurabh Mukherjea. On behalf of the LSE Alumni Association of Mumbai and Western India, I am Ankit Modi, the chair, and I am joined by my vice chair, Sharan Agarwal, communications coordinator, Yuvraj Borkhade, and students and recent graduates coordinator, Bhavya Reddy. To many of you in India who follow the equity markets on TV, online, or in print, Saurabh Mukherjea needs no introduction. He's on screens and on panels almost on a daily basis, and his analysis and opinions are not just heard, but debated. He is also the author of books such as Coffee Can Investing, Diamonds in the Dust, and The Unusual Billionaires, which have been translated into various Indian languages. But his actual day job is as the Chief Investment Officer of Marcellus Investment Managers, which he has founded. Most importantly for us, though, he is an alumnus of LSE, from where he earned both his bachelor's as well as master's degrees in economics with high honors. I am very pleased that despite us not being able to host this talk last year, we're able to do so today. I remember Saurabh's exact words then, and I quote, "I can't say no to anything to do with LSE." So with that, let's begin. Thank you, Saurabh, for joining us.
My pleasure.
And I will ask the audience to submit any questions into the Q&A box that they see at the bottom of their panel. And Saurabh will take those questions at the end of his talk. Over to you, Saurabh.
Thank you, Ankit. Thank you to everybody from the LSE Alumni Network who's on this call. I can already see some of my friends from my years at LSE. So it's a privilege being in front of you all. So let me tell you a little bit about what life had in store for me before the LSE. So I grew up in Delhi till the age of 14, and then my parents migrated to the UK. As luck would have it, they migrated to the deepest southern suburbs of London. And I ended up doing the last 3 years of schooling in South London. When school ended, I had applied as part of the university system there. I applied to a few places. And whilst I got a place in Oxford, it's LSE where I felt most at home. So I visited Oxford and LSE and Southampton, I remember, and Nottingham as part of the open days. But of all the various places I visited in those open days, and the places I got admission in, LSE almost felt instantly like home when I went for the open day. So without further thought, I finished school, went to the LSE. I have to say that the hardest thing I've done in my life was my 4 years at LSE. Anything in professional life, everything in professional life is really, really easy compared to what I had to go through, especially if I look back at second year macro and micro. I took macro 2 and micro 2, and my brain melted down. And then in the masters, just when I thought I'd finished graduation and masters would be easy, the masters was another sort of journey through hell. And by the time I finished my masters in 1998, I swore I would never study again. So that's when I became an economist. John Kay had taught at the LSE, but more importantly for me, John had set up a firm called London Economics. And London Economics at that time was doing strategy advice for firms like Tesco, for Lloyds Bank, for Halifax, and so on. So for the best part of 3 years, I worked at LE under John, learned how to apply economics to the real world. But by 2002, when I'd finished my CFA, I'd studied economics, I'd finished my CFA, and I figured that you could apply economics to the stock market in a reasonably straightforward manner, right? What economists call rent, or what economists call supernormal rent, is not very different from what investors call free cash flows. So in 2003, I saved up a bit of money, and I went to John and said, I want to set up a firm in London where I apply the economics I'd learned at the LSE and from John. I wanted to apply that to the stock market. John agreed to become the chairman of my little startup, and he also invested £20,000 in the startup. I put in some savings. A few co-founders joined me, and then October 2004, we got a license from the UK regulator to provide investment advice. So 2004, 5, 6, 7 were very happy years. We built this company called Clear Capital. We became amongst the highest rated, best rated small cap analysts in the UK. So the Fidelities in the capitals of the world, the hedge funds in the West End, the Scottish investment houses, family offices, those were our typical clients. And we used to get a profit share on the trades they would put up. Whilst going around and around the UK, doing my thing on research and selling that research to family offices, Jan 07, my colleagues and I realized that the British financial system was going to go to hell in a handbasket. And to be honest, it didn't require one to study at the LSE to figure that out, because you could see from the property prices prevailing in the UK. You could see from the imbalance between the modest salaries that British people earn versus the crazy house prices they were paying, that this was a disaster waiting to happen. All you had to do was a little bit of work to figure out that when the system blew up, which banks, which lenders would blow up. And we did that work. So from February 07 through to November 07, we published, I think, 450-page notes explaining which lenders would go bust, why they would go bust. And by the time it come to November 07, anybody who wanted to listen had listened to us and shorted the living daylights out of British lenders. That was the point where my colleagues and I sat down, November 07, December 07, and we said, let's sell this firm before the world blows up on us, right? And I think if I look back at my life, that was probably the best call we made, because if we hadn't taken the decision to sell that, this is 4 months before Lehman, 10th May 2008, we sold that business to a larger British investment bank. And at that point, my wife and I sat down and we said, what do son? And we made the call, let's move to Mumbai. Now, what
Saurabh, I think we may have lost you. Your video is frozen and we can't hear anything. I think we have momentarily lost Saurabh. Maybe he's having a problem with the internet. Hopefully he should be back on very soon once he gets it sorted out. So just hold on for a minute or so, please. Okay, we have you back, Saurabh.
Sorry, Ankit, sorry. Even though this is a corporate connection, I guess a broadband comes and goes. So I was just going to finish off the point on profit consolidation. So hitherto fragmented profit pools consolidated in the hands of say giant companies such as Hershey. So the confectionery profit pool consolidated in the hands of Hershey, condiments in Heinz's hands, apparel. Levi's became the largest seller of apparel in America. Breakfast cereal, Kellogg's, in retailing, Sears, and so on. So back in 08, I sat down and said, I don't know when this will happen in India, I said, but I said it'll happen at some stage. And it'll be a shame if my family and I were to miss out on this, right? So that was the main premise on which we boarded BA 138, right? BA 138 comes from London to Mumbai, and BA 139 goes the other way. We boarded BA 138 the day after selling the firm, that let's try to build a life in Mumbai and see if we are able to participate in both the networking of India and the consolidation of profit pools. At the back of my mind was also the thought that where should we raise a family? Should we raise our kids in the West? Because if you do that, then when your kids are 25, 26 years old, they will come to Mumbai and won't be able to cross the street, right? If you grow up in London, it's difficult to cross the street where our offices are in Andheri East in Mumbai. That'll be a shame, because by the time, I told myself in 2008, by the time our kids are 25, the center of the world will be Asia. The West will be a kind of poorer cousin of Asia by the time our kids are grown up, I said in 2008. And you raise your kids in the sheltered context of a Western city, and then they struggle in countries like China and India. That's unfair on the children. In contrast, you raise your kids in Asia, in India, they can then go and live anywhere they want to in the world, including living in India. So that was also at the back of our mind, that we wanted to raise the family in a place where when the children grow up, they have as many options open to them as possible, including the option of staying, working, and building a life in the fastest growing, most vibrant region in the world. And that's how the move to India happened in 08. There's a variety of things that then happened in India. I'm not going to bore you with all of that. But that was my journey from LSE to entrepreneurship, selling that business, then migrating to India. And it's now been 16 years in India. It's been a lot of fun. Today, as Ankit very kindly explained, my colleagues and I run a business called Marcellus, where we manage around $1 billion for families in India, for the Indian Navy's pension fund, for Western endowments, for pension funds in the Western world, for churches in the Western world. And it's a privilege to live in this country. It's a privilege to be able to travel around the world, convince people to invest in the Indian economy. And I have to admit that very little of this would have been possible without that 4 years of absolute pounding that the London School of Economics gave me. Because after that 4 years of pounding in the LSE, everything else feels pretty straightforward. So that's the background. Ankit, do you want me to do a presentation, or do you want me to start addressing questions? I'm happy to do the presentation because that might help people answer some of the questions that they're raising.
I think we can do, maybe half an hour of the presentation.
Why don't you do it? Okay, fantastic. So here we go. So I've started with the whole world, right? So I've taken the world's largest stock markets and put them on one slide. And when I go to America, especially, people get surprised by this, right? Because Americans have this preconception that they rock and other people don't. But actually, on a 20-year basis, the world's highest performing market is India, right? So on a 20-year basis, by some distance, India is the best performing market. And if you were to take a 10-year basis, it's America, but we're not far behind. On a 10-year basis, we are at number 3. Ahead of us is Taiwan. Taiwan has done well, but to be fair, Taiwan is primarily one company, which is TSMC. Right? Taiwan is really one company, TSMC. And you could argue TSMC's success is as much about America's semiconductor industry prowess as it is to do with Taiwan. But anyhow, on a 20-year basis, we are the best performing market in the world. On a 10-year basis, we're number 3. But if you look across the last 10 and 20 years, we look across the last 2 decades, what you notice, and I find this endlessly fascinating, what you notice that over the last 10 and 20 years, the only countries which have delivered double-digit returns, over 10 and 20 years are giant free market democracies, right? And I don't think that's an accident. I think giant free market democracies, they look ugly day to day. it amuses people no end that India goes through noisy elections and America goes through noisy elections. It amuses people, especially people who live in authoritarian regimes. They tend to get a lot of entertainment out of the fact that India and America go through noisy elections. But for those who live in authoritarian regimes, the reason free market democracies rock is they create contestability of power. They create contestability of power in politics, and they create contestability of power in business life. And from those contests, from those Darwinian contests, what emerges is this: you get superior long-term compounding of a sort that countries like China can only dream of. And perhaps one day China will have contestability of power. But until then, China can only dream of the sort of returns India and America generate over long periods of time, right? And this aspect, right? This aspect of why free market democracy rocks again goes back to the LSE. Karl Popper, The Open Society and Its Enemies. This man thought this through in the 1950s. Here we are sitting in 2024, understanding the power of open societies, understanding the power of why free market democracies rock. But Karl Popper figured this out 60, 70 years ago. George Soros took inspiration from that. And George Soros, as I'm sure many of you know, another LSE alumni, bankrolls with his substantial fortunes people who fight for open societies. Now, focusing specifically on India, why does India make so much money, right? America makes a lot of money in long run. Many people will not be surprised. They'll know of Ivy League, they'll know of Silicon Valley, all sorts of things. But a lot of people, including Indians, tend to get very surprised that India actually makes so much money. So why does India make so much money, right? I'll delve into that in sort of ever greater levels of detail in the rest of the presentation, right? So we'll start with the headline finding that the Indian stock market is the best performing stock market in the world over 20 years. These are dollar returns. Question is why? So let's just do one layer beneath that. So if you look at emerging markets, in emerging markets, India honestly has no equal. So if in 2012, you had invested $10,000 in India, that would have now grown to $23,000, right? So in 2012, you'd put in $10,000 in India, that would have become $23,000. If you had been crazy enough to put that money in China 12 years ago, it'd still be $10,000, or mildly above that. And if you had bought into this whole hype around BRICS and invested $10,000 in emerging markets, as an asset class in 2012, you wouldn't be particularly better off either. $10,000 12 years on would have become a meager $12,000, right? So India is an outlier in the context of EM. India is a complete outlier. We've basically made twice as much money as any other serious competitor in the EM cohort. Now, why is that? Why does India make more money? So one simple way to understand this is, open up a Bloomberg terminal or a Reuters terminal. Let's open up a global database and look across the world, right? And the simple test I set myself, and I did this actually 2008, I did this the first time, and every few years I do this test once again to check whether I've been rational about where I have chosen to live. So I give myself the following metrics. I say that I'm looking across the emerging world, and I'm looking at countries which can produce companies which can grow at 10% per annum in revenue terms over 10 years with a 10% ROE. So 10% revenue growth, 10 consecutive years with a 10% ROE, right? So call it 10, 10, 10. And let's label these companies consistent compounders, right? So consistent compounders by definition are companies who can do double-digit revenue growth over 10 years with a 10% ROE. And if you do this over the last 20 years, you take data for the last 20 years, what you find is only two EMs really matter, right? Only India and China really matter. The rest of the world is all right, but they really are not in the same league, right? Only India and China produce hundreds of such companies. India has 162, China has 126, and I'm sure all of you know China's economy is 4x larger, in fact 5x larger than India. So even though China has a bigger economy than India, China produces fewer consistent compounders than India. But the most fascinating result is the Indian 162 consistent compounders generate 26% dollar compounding. This is share price compounding over a 20-year period. So the consistent compounders in India basically are giving you 100x dollar returns over the last 20 years. Whereas the same caliber of Chinese company, generates only 10% return, right? And again, if you look at this chart, you'll realize that no other EM is remotely close to India's metrics on consistent compounding. We are an utter outlier. No other EM has managed to get to, and no other EM has produced so many consistent compounders. And even if they have produced lots of consistent compounders as China has, they simply can't match India in terms of long-term shareholder returns. So let's delve into why that is. Why can't any other country, and why can't China specifically, for all its much vaunted GDP growth, match India on compounding, right? So now this is now another level deeper into the Indian government's tax data. So on the finance ministry, on the Indian government's finance ministry website, the government gives you very granular data on tax collections, right? Unfortunately, they haven't given that data for the year to March 23 or the year to March 24 as yet, but thankfully they have provided that data for the year to March 22 already, right? So this came out a month ago, the year to March 22 data, right? And if you sort of crunch that data, a fascinating picture emerges of why India is able to produce so many companies which make so much money in the long run. So I'll quickly summarize the picture for you, and then we'll get into the core insight emerging from the Government of India's tax data. So there's around 400,000 companies in the country that actually pay taxes, proper corporate taxes, right? So there's 1.4 million companies registered to pay corporate tax, but out of those 1.4 million, 1 million file what is called a nil return, right? They don't actually pay any tax, they file a nil return. 400,000 companies pay taxes in India, right? The vast majority of them pay very little by way of tax, right? So the vast majority of them are paying basically less than $130,000, right? So these guys are paying less than $130,000, what we call the low PAT and medium PAT category, right? These guys are paying less than $130,000. These are small companies. Not only are they paying less than $130,000, as you can see over a 10-year period, they're barely growing their profits, right? So if your 100 becomes 150 over a 10-year period, that's barely any growth. So out of the 400,000 companies, basically around 390,000 are not even beating the rate of inflation in terms of their profit growth, right? So out of 400,000 companies who pay tax, 390,000 are struggling to beat the rate of inflation, right? Then you come to the high PAT companies, right? High PAT, we have defined it as high PAT as at least 130,000 of $130,000 of corporate tax payment. The high PAT category contains roughly 17%. So I would be wrong. The high PAT category contains 60,000 companies. So I'm sorry, the bottom two PAT categories, these contain 83% of the population. So 83% of the corporate population is in these category. The high PAT category, the black line, this is around 17%. So 17% of 400,000, roughly 60,000 companies are in this high PAT category. Now, what you notice is the high PAT category, the 10-year CAGR is roughly 15%. But what's interesting in the last 4 years, last 3-4 years, the CAGR has stepped up. As the 10-year CAGR is 15%, the last 4-5-year CAGR is closer to 25%, right? So something's happened in the post-COVID world or the post-GST world for the high PAT companies' profit growth to have pulled away even more from the rest of the companies, right? Out of that 60,000 who are in the high PAT category, when you delve into the government tax data and you look at the companies who are in the high PAT category, out of the 60,000 who are in the high PAT category, around 6,000 account for 90% of the profits in the country, right? So 6,000 companies end up accounting for 90% of the profits in the country, right? So I'll quickly summarize again. 1.4 million companies registered to pay tax, 1 million pay zero taxes. Out of the 400,000, 83,000 pay very little tax, and they have not shown any growth in their profits in meaningful terms. You're thus left with 17% or 60,000 companies who are growing profits at a healthy rate in India. Out of that 60,000, 6,000, 10% out of that 60,000, 6,000 companies in India have compounded profits at 15% per annum. Last 4 years, that's become 20%. These 6,000 companies are the companies that are of great interest to us. Now, why are they of great interest to us? Because if you then delve further into this data on the 6,000 companies, what you find is that the largest of them, the first decile 1 is not the fastest growing decile. The top 600 companies in India are not the fastest growing companies. If you look at these 6,000 companies, the second decile is where the fastest growth is, right? And again, notice how in the post-COVID world, the slope ramps up, how the difference in slope between decile 1 line and the decile 2 line. If you notice how the slope ramps up in the post-COVID world. So what's happened in India over the last 5-6 years is the second decile companies, right? I call these challenger franchises. The second decile companies have done spectacularly well in accelerating the profit growth. So this is India's, what you're seeing on the screen on the top left is India's fittest, fastest, bestest 6,000 companies. But if you were to decile them, it's not the top decile which is growing the fastest. It's the second decile, right? And then if you sort of put it in a framework, what's happened broadly in India is this, right? And this is why India has become such a powerhouse in the last decade or so. So let's break India into organized companies and unorganized companies. Unorganized companies are those who don't pay tax, right? These are black economy companies, they're tax evaders, right? And then you break them into large companies and small companies, right? You break them into large companies and small companies. Courtesy the attack on black money, courtesy GST, there are no large companies left which are unorganized, right? So the large and unorganized is now a null set. A decade ago, that wasn't the case. I don't know how many of you read about it. There was a guy called Ponti Chadda, for instance. So Ponti Chadda used to run this massive liquor empire out of Delhi, right? So a decade ago, you had large companies that were in the black economy, right? Effectively mafia type setup. So Ponti Chadda ran this colossal liquor empire out of Delhi. I think he got gunned down. He got gunned down in a sort of battle in one of the farmhouses outside Delhi. So over the last decade, this top right-hand corner, this has become a null set, right? And I think that's quite a good thing that we don't have large companies which are unorganized. Large organized companies are, say, HDFC Bank, Asian Paints. We call these guys rulers. These are the big companies that you hear about every day. These are the big companies whose products many of us are using in India on a daily basis. Although by count, they're only 800. These guys account for 60% of the nation's profits. And as we discussed, their profits are growing at a solid rate, 15%, right? This is the kind of establishment. The rulers are the people who run the country. They're the establishment. The dynamism in India in the last 4-5 years has really come from here. This is where India has created a coterie of companies who are quite unique. These are probably the fastest growing companies in the world. 5,000 odd companies, the challenger franchises, 5,000 companies, the challenger franchises, earning profits between $6 to $60 million. So actually companies very similar to Marcellus in size. We are a classic challenger franchise, small company, but growing fast. $6 to $60 million, 5,000 such companies in India. Profit growth over the last 10 years has been 16%. But even more dramatically, profit growth in the last 4 years has been closer to 25-30%, right? Profit growth in the last 4 years has been 25-30%. And the challenger franchises is really where much of India's unicorns, private equity action, IPO, small cap action is happening. This piece around India, the fact that India has been able to create 5,000 companies to challenge giants like the Birla Empire, the Ambani Empire, the HDFC Empire, the Tata Empire, that aspect, the fact that India has been able to create contestability in a large free market economy has created acceleration in stock market returns. It's created acceleration in profit growth. Now, how did this happen? How did challenges come about, right? I'm going to give a quick summary. So the quick sort of 1, 2, 3. First thing that happened a decade or so ago was the unorganized large guys got killed. Unorganized large companies got killed. Then the smaller companies, the plebeians as I call them, the vast majority of India's smaller companies, they started getting crunched. The profits started moving from the plebeians to the challengers. The profits started moving from the plebeians to the challengers. Today, the plebeians only account for 15% of India's profits. The challengers account for 25% of India's profits. And I think the coming wave, the future is the challengers attacking these guys. The challengers are highly disruptive, lean, very tech savvy digital business models. So the challenges already cleaned up the plebeians, and I think the next decade will be companies like us challenging far larger companies, or generally the challengers going after the establishment in India, right? The challenges going after the establishment in India. So how did this happen? Let me just give you a quick summary of what transpired in India to allow these to happen, right? And in a way, this goes back to America. This goes back to America 1872, America 1882, 1940. They did it through railroads and telegraph. We are doing it through UPI, the India stack more generally. So let me just quickly give a quick summary, especially for those who don't live in India, what's happened in the last 10 years. So I'll start in 2010. 2010, Nandan Nilekani, who used to be the CEO of Infosys at that point, Nandan quit Infosys, joined the government of India, and created something called Aadhar, right? So those of you who are in India, you know what Aadhar is. For those of you who are not Indians, Aadhar is a unique digital ID that all of us have. There's a number that's associated, but more important than the number is Aadhar also has a fingerprint and a retina scanned onto it, right? I bumped into Nandan in Bangalore airport, I remember in 2013 Jan. And I started discussing Aadhar. I was mighty curious why he was doing it. I couldn't fully understand. And he asked me to join him in a Innova ride in his car from Bangalore airport to a notorious traffic black spot called Hebal. That's roughly an hour ride. And in that 1 hour, the man told me, Nandan told me back in 2013, word for word what's transpired in the next 10 years, right? So Nandan figured it out long before any of us had why Aadhar was going to be transformative. As I'm sure many of you know, the UPA lost the elections. The party that Nandan belonged to lost the elections in 2014. But what intrigued me was very soon afterwards, Nandan met the Prime Minister. It was reported in the newspapers. And a couple of weeks after that, somewhere in October, November 2014, Prime Minister Modi announced something called Jan Dhan, where he said that by the end of 2015, this is October 2014, the Prime Minister said that by end of 2015, all Indians will have a bank account. And I think a lot of us, including myself, had a chuckle saying, how will that be done? And then I watched both from Mumbai, and I visited Delhi a few times to watch this firsthand as the government cracked the whip. And in 15 months, India opened 400 million bank accounts. Indeed, by Jan 15, all Indian families had a bank account, and the government of India mapped Aadhar with the bank account. Then in 2016, Mukesh Ambani ji launched Jio. Broadband was and remains cheaper in India. Broadband costs are 1/50th of American or European costs in India. India now uses more mobile data than the whole of North America put together. So if you add up USA, Canada, Mexico, they use less mobile data than India. India uses more mobile data than all the countries in Europe added up, right? This is the power of low-cost broadband. Now, again, Nandan figured out why this was a critical move. And 2017, he went to Delhi that year, 2016. 2017, the National Payment Corporation of India launched UPI, right? Unified Payment Interface. And again, for those who don't live in India, UPI is peer-to-peer payment using our phones. Our phones are mapped onto our bank accounts. Our phones and our bank accounts are mapped onto our Aadhar IDs, and that becomes a zero-cost payment system. As you can see here, 55% of national income 55% of national income now flows through our phones and growing exponentially. I think no other country will be able to match this, and this is going to grow exponential. This is zero cost. Unlike Visa, MasterCard, this doesn't cost any money. And for small businesses, this has been transformative. So if you ever visit Marcellus and Andheri West and Andheri East, all of you are welcome to visit us. You'll see that the coffee stalls outside our office, they don't take cash, they don't take credit cards, they only take UPI, because for them, UPI is costless. It doesn't involve going to the bank, and they can pay their vendors, whoever they buy milk and sugar from, instantaneously. So UPI at one stroke transformed for SMEs the cost of doing business. The second benefit of UPI was because the banking system can now track UPI payments, right? So the coffee vendor outside my office, Kotak Bank or HDFC Bank can see every transaction he's doing. SME financing thus took off in India. right? And SME financing took off in India. You can see in this chart, SME lending has doubled in the last 4 years, right? The fastest growing part of the Indian banking system now, the fastest growing part of the Indian banking system now is banks lending to small businesses. The same small businesses who used to borrow in the black market at 20, 21, 22%, now borrow at 10%. And you can see why this is giving a whole fillip to a challenger class, right? So you have the Aadhar construct, then you have Jan Dhan on top of it, the bank accounts, then you have basically close to free mobile. Then you lay the UPI piece on top of that, right? Now consider that on top of this, you have 700 million people with access to costless broadband. That means the cost of building for a small business to build a national brand online, to procure raw materials from any part of the country, to sell in any part of the country costlessly, those transaction costs have absolutely been crushed in India, right? Now, again, back to our LSE days, right? Ronald Coase, and the theory of the firm is when you crush transaction costs, the need to do activities within the firm reduces, right? Why does a firm exist? Why do gargantuan companies exist? Because having a department inside a firm is a lower cost way of doing things than were that department outsourced. So you have an HR department where your head of HR does appraisals and pay rises. But if you create a construct where your HR can be outsourced or your payroll can be outsourced, courtesy technology, courtesy low cost broadband, courtesy costless payment, then more and more businesses outsource more and more things. That in turn gives a colossal fillip to small businesses, right? So again, if I look at Marcellus, we started 6 years ago. We started with 2 desks in a serviced office in Andheri. I set up the firm from my mobile phone, sitting in a Airbnb in Spain, right? I didn't have to visit any government official. I didn't have to bribe anybody. I simply sat there. I logged on to the Ministry of Corporate Affairs website, incorporated the firm, capitalized it. Then I flew back from holiday in Spain. This is back in 2018. My one colleague then and I applied to the regulator for a license. Again, we didn't have to bribe anybody. We didn't have to go and massage anybody's ego. We applied online for a license to manage money. A month later, the regulator came to visit us in our small 2-desk office in Andheri East. We got a license shortly thereafter. In the first 3 years of Marcellus, we barely did any trips traveling around the country marketing. All our marketing was on Zoom. When clients started coming, the sign up was online, right? The entire sign up was online. We made it as paperless as possible using the India stack, using Aadhar and eKYC. And from zero to $1 billion, we haven't had to raise venture capital funding or PE funding. From 0 employees to 100 employees, we're broadly still in the same neighborhood of Mumbai. And we are not the only people, as I said, we are a part of a challenger ecosystem of 5,000 companies who are coming through. They're coming through because of the charts you're seeing on the screen, right? So that's the story of India. There are 5 effects that this has had. There's a book coming in September where my colleague Nandita and I have laid this out. But just to quickly summarize, the first effect is women now rock in India. They have more money than men. They earn more than men. They have more money in the bank than men. So I don't know what exactly Indian men will be doing 10 years hence, but we for one are focusing on investing increasingly in areas where women spend money on. Secondly, people like me, and I dare say people like us, are increasingly in a minority. For the first time in India, we can see in the data that graduates without elite qualifications, regular graduates from regular universities like Amritsar and Punjab and Delhi and Bombay, regular graduates now run the majority of our largest companies. Privileged education is, I think, at one level increasingly irrelevant in India. In fact, most of my venture capitalist friends expressly look for people who don't have privileged education, because they believe that people with less privileged education tend to have far greater entrepreneurial verve. Thirdly, Southern India is the fastest growing part of the world, right? Southern India, the peninsular 7 states, and I'm including Maharashtra here in Peninsula. The peninsular 7 states account for a quarter of the population, half the GDP, and 60% of India's growth, right? India is increasingly a a peninsular story. Not much of note is happening in much of the rest of the country. Law and order, education, human capital, physical infrastructure. Peninsular India is increasingly pulling away from the rest of the country, and this is the fastest growing part of the world. States like Telangana, Tamil Nadu, Andhra are doubling their GDP every 6-7 years, right? I'm sure all of you heard about the tensions between China and America. That's creating a massive opportunity for India, specifically Gujarat and southern India. And lastly, the shortage of white collar labor in the Western world. Countries like the UK, USA, the continental European countries simply don't have enough people to do payroll, HR, sales, marketing, strategy, and all of that is ending up in India, increasingly in smaller cities in India. So Tirunelveli in Tamil Nadu, Coimbatore in Tamil Nadu, Madurai, Tiruchirappalli in Tamil Nadu, rather than just Chennai and Hosur. Nashik in Mumbai, Nashik in Maharashtra, Indore in Madhya Pradesh, right? So increasingly second tier, third tier cities is where these global capability centers are setting up. And that's good news for India. That's good news for everybody, because I think given the infrastructure challenges that a Bangalore or a Mumbai or a Gurgaon faces, it's just as well that places like Chandigarh and Indore and Nashik are actually growing and getting these GCCs. I'm not going to get into the details of these folks. I think I'm sure you all had a long day at work, but this is my my journey in India. My privilege, been a privilege to sit in this country, see it change, and see it become the kind of epicenter of global vibrancy. And for those of us who live here, it's a privilege. Those of you who live outside India, I hope you can travel here and also see firsthand what's panning out in India. I'll stop there, Ankit, and I thank all of you again for this opportunity.
Thanks so much, Saurabh. That was very insightful. I think we all learned a lot of new things. And it was also great to hear about your journey from the LSC up to Marcellus. I have a few questions which have come in into the Q&A box. I'm just going to read them one after the other. There's about 3 questions right now. The first one from Jitin Sehgal. He's asking, should an average investor with moderate returns expectations, which is 12 to 15%, sticking to SIP in indices, is that the wise choice? And he has a follow-up question where he says, further to the above, would you recommend Nifty 50 or Nifty Next 50 as the choice of index for SIP for moderate investor returns? If the concentration in India is as concentrated up top as you have been saying, curious, why does Nifty Next 50 give better returns than Nifty 50?
So I think first, I think you're making all the right points. If you look at India's long-term returns, if you can get $10%, $10% is rupee 13%, or even better, if you can get $13%, which is rupee 16%. Those are great returns, and if you can get that through tracker funds, which you can, then you shouldn't really kill yourself trying to do a lot more. It's not always the case that Nifty Next 50 gives more than Nifty 50. Usually it's the case, but if you see corrections, and especially corrections which are where large caps hold up more than small and mid caps do, then Nifty will hold up more. I think we have one of those junctures in Indian history where if you look at the share of market cap that the Nifty accounts, that's fallen sharply in the last 10 years, but Nifty's share of India's corporate profits hasn't fallen. So Nifty's share of profits hasn't fallen, but Nifty's share of market cap has fallen. And therefore, if we get a correction in the next 12 months, which I wouldn't rule out, I would submit to you, Nifty could do better than Nifty Next 50. But if you take you sound like you're a young man. If you take a 3-year, 5-year view, it shouldn't matter which one you invest in, Nifty or Nifty Next 50. Both of them should give you pretty healthy returns.
A lot more questions have come in, so I'm just going to go through them. I hope you can answer all of them. Saurabh, so the next one is from Murli S. He asks, in your opinion, what should be done to promote India as a value addition alternative as opposed to a cost-cutting alternative?
I don't think we need to promote. I think it'll anyway come through from what we are seeing and hearing for the global investment banks who have giant GCCs in India, for Google, Microsoft, Apple, who have their largest offices outside America and India, for firms like Boston Scientific, GE, who have massive R&D centers in Bangalore and Hyderabad. I think for these firms, India is already doing business critical work for them. I doubt that the JP Morgan folks in India, or the Goldman Sachs team, or the Microsoft team in Hyderabad and Gachibowli, I doubt they're doing anything other than super critical work for headquarters. So just that these firms perhaps don't want to talk about it openly, because that then gives away how much of value they have in India, which then opens them up to competitors trying to poach their talent. But my reading of the situation is, for much of the Fortune 500, what they do in India is already increasingly the core, the guts of what makes them valuable enterprises. So I'll give a quick example of this, actually, since it's been raised. So I was in America on a business trip 4 months ago, and I was on a train from Boston to New York, and it's called an express train, but it actually doesn't move very fast. So it's trundling along, and the lady next to me was hammering away on our MacBook, writing messages in her instant messaging box. So I was very intrigued as to why and how over sort of 4 hours somebody could keep instant messaging. So I asked her finally, "What are you doing?" And she said she worked for I won't name the brand, but it's a famous electronics brand. It's a brand whose headphones are very famous. So I said, "What exactly are you messaging then?" She said, "Look, our design center is in Boston, but all the core work is done in India and Pune, and they're done by people from Tata Elxsi." So Tata Elxsi is this engineering R&D firm. It's a subsidiary of Tata Sons. So all the coding work, all the guts of what we do actually sits in Tata Elxsi in Pune. So I asked her, "Well, don't you guys feel uneasy about that?" She said, "Well, we might do, but what do? We can't persuade these guys to relocate from Pune to Boston. We have given them job offers, but they don't want to come to America. And in America, we simply won't be able to find coding talent of this quality." So she said, as you can see, and she showed me her instant messaging box. She was giving broad directions on what they needed in the next line of headphones that they were making, but all the core design, coding, R&D was being done by Tata Elxsi out of their offices in Pune. And I think this is the increasingly going to be the relationship between India and the West, where much of what constitutes value in science and chemistry, in engineering, will be done in India, but it'll have a Western front end and a Western financier behind it, because the capital, the deep pools of capital that you need to do research, high-tech research, we still don't have it, right? To come up with a drug, I think takes to discover a new molecule takes several $1 billion. We still don't have a pharma company in India who can blow several $1 billion on discovering a new molecule. The research work will be done in India, but the financier will be a Pfizer or a Merck. But the R&D will end up getting done more likely than not in Bangalore or Hyderabad by, say, a firm like Divi's Lab. And that makes sense. At this stage of our evolution, where our cost of capital is still reasonably high, Western capital should be the risk capital, and our people should provide the brains. As we get richer, remember, we are amongst the 50 poorest nations in the world, right? So there are 190 countries. We are ranked 139th or something on per capita income. We're a desperately poor country in per capita income. So it's just as well that Google or Apple or Pfizer or Merck is putting the risk capital at play, but Indian brains are being applied in Bangalore or Hyderabad or Pune to get the needful done. As we get richer, we will provide the capital and Indians will provide the brains as well.
Okay, more and more questions coming in. I think I'm going to club some of the common ones. One of the common themes is the sectors which are going to grow and deliver above average returns. Do you see any policy decision impacts on any of these sectors? Needless to say, there's questions about the budget and your take on the long-term capital gains tax. I don't know how you want to answer them, because there's...
Yeah. So look, I think, folks, one thing I think I would suggest to everybody, let's get out of this fetish about sectors. There's no money to be made by obsessing about this or that sector, right? It's rarely ever the case that one sector will make money and other sectors will not. Usually the nature of free market economics, right? The nature of free market economics in LSE, we learned the theory of tournaments. The reason it's called theory of tournaments is, just to use a simple sort of example, at Wimbledon, the Wimbledon winner makes 500 times more than the first round loser, right? Whoever wins the Wimbledon final, that guy or girl gets 500x more than the first round loser. So the broad name given to this phenomenon is called the theory of tournaments, right? So free markets work on theory of tournaments. In any industry, the returns get polarized, whether it's stock market, whether it is IPL, whether it is the pharmaceutical industry, whether it is manufacturing widgets, anything, returns will get polarized. The winner will make uh, many multiples more than the 10th place guy or the 50th place guy, right? So remember, that's how free markets work the world over. There is no sabka saath sabka vikas in free markets. It's not as if real estate will do well, so all of us have to buy real estate, or auto will do well, right? That sort of nonsense really doesn't work. So the trick to then think through is look for monopolists in industries. The monopolist will pretend not to be a monopolist, right? The monopolist will pretend as if he is a regular company. And your job, my job, is fundamentally to look for companies who are actually monopolists, making way more than the rest of the peer set, but pretending not to. So the most banal example, but I think an instructive example, is Nestle. Nestle India makes 140% return on capital. They have 95% of the infant milk powder market. Infant milk powder in India is a $2.5 billion market. Their volumes grow year after year. This has been happening since I was born. The volumes grow at 10%. Their revenues grow at 13, 14%. Their profits at 16, 17%. Their cash flows at 18, 19%. But Nestle pretends to be just another FMCG company, but it actually isn't just another FMCG company. It's a company that is head and shoulders above any other FMCG company in terms of the profitability of the business and its ability to reinvest vast sums of money, right? And this is bound to be the case. The monopolist will keep their profile low. They're not going to be sponsoring tournaments and attending glitzy weddings or hosting Bollywood premieres. The monopolists will keep their mouth shut, keep their profile low, gobble up entire industries, and the trick to do is identify them and invest in them and make money. And don't expect them to come on broadcast TV on CNBC and talk their stock up, because they'll not be interested in doing that, right? So forget about looking for this or that industry to invest in. Forget about looking for reading the newspapers and identifying who's the next big thing to invest in, and just realize that the skill in investing, I suspect around the world, but certainly in India, is to identify these introverted people, the introverted entrepreneurs who have built fabulously profitable businesses, but who keep a low profile and just mint money for you and me, right? So I'll just quickly highlight the book I first wrote on this. If you are interested, you can read this. So on Amazon, you can go and read this. This is called The Unusual Billionaires. So I published this 6-7 years ago, right? I think this is the Kindle version or paperback version. Diamonds in the Dust is also a kind of do-it-yourself investment guide. But to understand the psyche of a monopolist, read Unusual Billionaires. It's probably the easiest way to understand that. Now, another book you can read, which is even better than I think my book, is a book called 0 to 1. So 0 to 1 is a book written by Peter Thiel. I read it, and that's how the inspiration for starting Marcellus actually came in 2016. So Peter Thiel, 0 to 1, he explains this construct as to how do you think about your own business, how do you think about killing all your competition and building a dominant franchise. And if you don't want to read, then there's a brilliant video on YouTube where Peter Thiel basically lectures a group of Stanford Business School students. The video on YouTube is called Competition is for Losers. It's a 1 hour video. If you can watch that video and read the book, I promise you that's probably the best education you will get in how to build a dominant business. So Competition is for Losers. It's a free video on YouTube, and the book is 0 to 1. That is India. That has been applied by Indian entrepreneurs. I don't think they were waiting for Peter Thiel to explain it to them. I think many Indian entrepreneurs instinctively understand this, that keep a low profile and think of ways to completely decimate the competition, gobble up the whole industry, don't seek funding from outside, and then become a billionaire. So there's another company. I'll give you a kind of mini, right? I invested in this first a decade ago. They
I think we may have lost Saurabh again. Maybe his connection is not
Has
this not
come
that
through.
good.
Sorry, can you hear me?
Yes, we lost you for a second there. Saurabh, I think you're frozen and we can't hear you. Okay, I think we have lost Saurabh. He may go off. I can wait for another few minutes if he's coming back, but also we should probably wrap up the talk. It's been an hour now almost. Let's wait for maybe 2 or 3 minutes. Yeah, I think he's back.
No, sorry, where did you lose me, Ankit?
Honestly, I can't remember, but
I was just explaining then why you Garware and why the investment, the nature of the nature of successful investing in India involves identifying large caps like a Nestle or a small cap like Garware Technical Fibers, companies who utterly dominate their industries but do so quietly and create colossal amounts of wealth without creating any publicity around it.
Saurabh, we have questions fairly specific to investing, some to do with your funds. I think we will skip those for now. And I think we can take one more and then maybe wrap up.
Sure.
So we have, a question on, I want to make it one. I think it's on the emerging technology and AI that, may be affecting Indian companies as well as, maybe what you're looking at, but also what are the kind of challenges that Indian companies face going forward, and how do the challengers defeat the incumbents? I think we can make that into one.
Yeah. So let's focus on what are the challenges companies face in our country. I think the first is, as I was saying a few minutes ago, cost of capital is still pretty high in India, right, compared to the Western world, or indeed even compared to China. Like in China, cost of working capital is 2 or 3%. In India, if you were to go to a large bank like HDFC or Kotak and take a working capital loan, it's more like 10%, right? So cost of capital in India is high, even by relative to other emerging markets. Cost of land in India is insanely high. Part of the challenge is because we're a fertile country, much of our land is used for agricultural purposes. But that means cost of industrial land in India is much higher than, say, a Vietnam or a China, and especially in, say, vibrant industrial states like Gujarat or Maharashtra, it's increasingly tough to get decent slugs of land to build factories. Now, third area is cost of labor, right? If you look at minimum wages in Maharashtra, they are 3x that of Bangladesh. So if your land is expensive and your labor is expensive and your working capital is expensive, it rules out a broad swathe of manufacturing activities. You really can't compete in labor-intensive products like t-shirts and sports goods. You can't compete against a Bangladesh in t-shirts because their minimum wages are 1/3 of yours. You can't compete with China in capital-intensive industry because their cost of capital is so much lower than yours. You can't compete in heavy industrial products which require lots of land because your land is so expensive. So what it does is it sort of hems India in. It hems India into this kind of small, tight corridor of knowledge-intensive products like pharmaceuticals, like global capability centers, like IT services, which is fine for the entrepreneurs, the challenger class, which are building great pharma companies and great tech companies in India. It's good for them, but it does create a broader issue on how will we employ, say, another 200 million people who are jobless at the moment? How will we employ them if our factor costs are so high, right? So the government is trying to tackle this through PLI, but it's a big ask. I think it's a big ask for India to be able to sort of give a production-linked incentive to overcome so many issues around high factor costs. I think that's the biggest challenge all of us face in the country. People like us have it easy because in an industry like asset management, we don't need land and we don't need working capital. Neither do we need lots of people. But imagine someone who's trying to say build a business around creating ceramic coffee mugs like this on scale. Can he really compete against countries like Vietnam, China, Bangladesh? I would think it's pretty tough. And I think that's where our policymakers have a lot of work to do. How do we create an environment where you can get labor, educated labor at a decent cost? How do you make it easier for entrepreneurs to buy land? And how do you make affordable working capital available? I think there's a long way for India to go on that front.
One quick question which had come in earlier from my colleague Sharan Agarwal, who's our vice chair. He wants to know about the angel tax, removal being a good or bad move from the perspective.
I think that's a good thing. I think the whole tax piece I thought was brilliant. I think policymakers in India don't get the credit they deserve. It's been an issue for a long time. I think any Western economy, our policymakers, our central bankers, our civil servants, our politicians, they can take on the best in the world. And having seen policymaking in the West and in India, I think at many levels, hands down, we have some of the best policymakers in the world. In SEBI, in RBI, in the finance ministry, outstanding brains. I thought the tax construct in today's budget was spectacularly good. Brilliant job by the FM. Hats off to her. The thinking through of why STCGT should go to 20%, why angel tax should go to 0, why LTCGT should go to 12.5, why she's made it unviable to do corporate buybacks. And I know and over time I've got to know many of the people in SEBI and in the finance ministry and in the RBI. And if I look back at my years in the UK and I compare them to friends I know in America or in Brussels, I think we can be very, very proud. We have some really, really smart people making policy in India. They work bloody hard. They take tough calls. They stay behind the scenes, and I don't think they get the credit that they deserve.
Okay, I think that concludes the Q&A and the talk as well. I want to really thank you, Saurabh, for a really great talk. We're so happy that we've had you on, and I think with the number of questions, we'll probably ask you to come on again. We also want to, help our alumni with, not just informing them, but also, whether it's practical skills like investing or career related opportunities and insights. So I think this has been very helpful on many fronts. Just so you know, we are continuing this kind of thematic approach, and next month on the 20th of August we have an online talk with your fellow alumnus, Professor Sanjay Bakshi. So I hope you tune in for that, and maybe in the future we'll have both of you, facing off.
On the professional guidance front, Ankit, if you guys want, we're happy to host whoever is interested in learning from whatever I've learned in India. Happy to host them in our office in Mumbai. We don't have a colossal office, but we have a large boardroom and we have enough space in the office. So if you guys want us to host whoever is looking for career guidance, happy to do a chat one evening over coffee and snacks in our office in Andheri East.
Absolutely. We will definitely take you up on that, and we will have, I'm sure, more to do with you and Marcellus going forward. Thanks again for spending so much time with us, and it was really great to have you, Saurabh, and we're really grateful. Thank you.
My pleasure. My pleasure. Thank you, folks. Have a good night.
Thank you.